So we've had a reasonable engagement with Bramson over the last year. We'll see him again in March. He really hasn't laid out his strategy to us. We read the press and see what we say. We want to engage with all of our shareholders, and we do. But we had a great year last year. We more than doubled our profitability through the first 9 months of 2018, from sort of 7% ROTE in 17 to over 11 in 18. We more than tripled the amount of capital that we returned to our stakeholders last year. So we are very comfortable with the trajectory of the bank. We think we've got the support of our shareholders, and we'll engage with Bramson when he wants to and exchange ideas. But for now, the bank, I think, is in a pretty good place, and the shareholders are pushing us forward.
You always give a very good and reasoned read on what is going on with capital markets. Timing is difficult here, isn't it? Because he's suggesting that you step away from these markets at a time when actually these markets look troubled by concerns about growth and the possibility of recession. Are you worried about the volatility this year for markets generally and what that might mean for trading and investment banking business?
I think actually lack of volatility is what puts pressure, I think, on those that are intermediaries in the capital markets. What you want is volatility, and you want liquidity, and you want activity by the buy side. I think this year we will see a return to more normal levels of volatility. 2017 was the lowest level of volatility in the history of the financial markets. 2018 had a couple of pops very much towards the end of the year. I think we're going to have a more normalized level of volatility. In fact, that's a positive thing for the intermediaries of the world's capital markets.
Let's go back to not so much the Bramson point, but your share price performance, because I look at the stock, and I've got it in front of me now, and in 2017, £2.40. 2019, we got down to, at our lows, just below 150 as well. I take what you're saying about the ROTE. I take what you're saying about a whole host of measures where Barclays looks good, and I will give one of my own. I think your net interest margin above 3% wipes the floor with the likes of Royal Bank of Scotland. Why does the market think your company is only worth 0.6, 0.7 price to book?
I mean, one of our challenges is we are a European bank. And in fact, if you look at how the sector has traded, whether it's a bank in Switzerland or France or the UK, there has been a trade-off against the European banking sector of extraordinary proportions over the last 12 months. And we are not immune to that. What we have to focus on as a management team is what we can control: the capital level of the bank, the profitability of the bank, the strategy of the bank, and the prospects of the bank. And I feel comfortable where we are. We can't fight the tape when the tape is as strong as it is. I think the question for all of us is, why is the market so negative on the banking industry, and particularly so negative on the bankruptcy across Europe? And that's a question that I think we all need to face.
Can I give you an answer? Because they see the levels of debt building up globally. We had Tim Adams from the IIF in recently. Let me pick a number. Non-financial corporate debt has gone up from $27 trillion less 10 years ago than it is now. $72 trillion, and which equals 92% of global GDP. That's why, because people are worried about the underlying business.
I think those risks are very relevant, are very real. And the issue is, how is a bank like Barclays positioned to take on those sort of risks? We have had a very conservative credit profile on our balance sheet post the referendum vote of over 2 years ago. We are very comfortable that we are positioned for that sort of movement in the overall credit markets if it comes. We're an intermediary. It's not like in 2007 where we would take these lever loan positions and leave them on the bank's balance sheets. They're not on our balance sheets. They are placed with the capital markets. And what we want to be is a provider of liquidity when you have the disruptions, because there are some stress levels in the overall levels of debt, BBB, that sort of space that you've talked about. But we're very comfortable that Barclays is positioned for the stormy way. And in one sense, to ultimately prove the strategy of the bank that we started in March of 2016, a recession might actually give the underlying evidence why this is the right, to have a diversified model where we're diversified by client, by geography, by business. That's what you want to be if in fact we are going into tough waters.